Chairman Frank, Chairwoman Velasquez, Ranking Member Backus, Ranking Member Graves, committee members, thank you for the opportunity to today's joint committee hearing to discuss the availability of credit to small businesses. The timeliness of this hearing is highlighted by findings released just this week in a study by the National Federation of Independent Business. They found that of small employers who attempted to borrow in 2009, nearly one-half received all the credit they wanted, but almost a quarter received no credit at all. This compares to a similar study in 2005 when nearly 90% had most or all of their credit needs met and only 8% obtained no credit. These statistics are concerning to me in my current role as a policymaker and a bank supervisor, but they're also distressing to the part of me that spent 30 years as a community banker and a small business lender. I know all too well the anguish of businesses struggling for survival and the bankers trying to meet the needs of their customers in the face of mounting credit losses. While conditions in financial markets continue to improve, access to credit remains difficult for many smaller businesses that largely depend on banks for credit. Risk spreads on small business loans at banks have continued to rise, and the decline in loans outstanding has been stark. A number of factors are contributing to the reduction in bank loans. For instance, in response to rising levels of delinquent and non-performing loans, banks have reduced existing lines of credit sharply and have tightened their standards and terms for new credit. In addition, banks with capital positions that have been eroded by losses or those with limited access to capital markets may be reducing risky assets to improve their capital positions, especially amid continued uncertainty about the economic outlook and possible future loan losses. The reduction in the availability of credit, however, is not the whole story. There's also less demand for credit. As businesses reduced inventory levels and capital tend to pay down debt and build cash positions, and while some potential borrowers are ineligible to borrow. Weakened balance sheets, reduced income, falling real estate collateral values, and history of payment problems have made it difficult for some businesses and consumers to qualify for loans, especially under current stricter standards. A significant fraction of small businesses rely upon personal assets and consumer credit to fund their operations. Thus, small businesses are impacted by tight conditions for consumer credit in addition to those for business credit. And finally, small business lending is often based on relationships that are solidified over time, and when those existing relationships are broken, small businesses find it quite difficult to establish similar arrangements with a new bank. Improvement in a number of the conditions that depressed lending in 2009, however, lead me to be somewhat optimistic that we may begin to see an increase in bank loans later this year. Economic conditions, the most important determinant in the demand for and availability of small business lending, have improved considerably since the early and middle part of last year. In response, bank attitudes toward lending, including small business lending, may be shifting. In the January Senior Loan Officer Opinion Survey, the number of banks that reported the tightening of credit standards for small business lending no longer outnumbered the banks that reported an easing of lending standards. Federal Reserve has been working with banks to foster improved access to credit and prudent underwriting of new loans, and we will continue to do so. I believe that the considerable support we gave to bank lending through accommodative monetary policy and borrowing facilities has been critically important. In addition, to ensure that supervisory policy does not inhibit lending, Federal Reserve joined with the other banking agencies in supervisory guidance that emphasized the need for banks to continue to meet the credit needs of creditworthy borrowers while maintaining appropriate prudence in lending decisions. Recent guidance covering commercial real estate lending also encourages banks to work with borrowers to restructure troubled commercial real estate loans in a prudent manner and reminds examiners that absent other adverse factors, a loan should not be classified as impaired based solely on a decline in collateral value. The Federal Reserve has supplemented and reinforced this guidance through outreach to banks and training for bank examiners in a variety of forums. The Reserve Bank's regional and topical meetings on small business access to credit. Some, such as the ones held this week on minority entrepreneurship and SBA lending, will focus on specific topics. Others will focus on identifying regional differences in credit availability. The Reserve is committed to using all available tools to maintain the flow of credit to the economy, especially the critically important small business market. We thank you for holding this, and I look forward to your questions.